On a warm July evening in 1944, while Allied tanks rolled across Normandy and the Red Army closed on Warsaw, 700 delegates from 44 war-torn nations filed into the gilded ballroom of the Mount Washington Hotel in Bretton Woods, New Hampshire. For 22 days, they argued, negotiated, and finally signed their names to the agreement that would make the United States dollar the undisputed center of the post-war world. The dollar would be convertible to gold at $35 an ounce. Every other currency would be pegged to the dollar. And America, holding 70% of the world's monetary gold, would become the final arbiter of global finance. It was not merely a treaty, it was the quiet coronation of a new monetary empire. 81 years later, that empire is dying in plain sight. In the first 8 months of 2025 alone, foreign official institutions sold a net $8 and $12 billion of U.S. Treasury securities, the fastest exodus since the Federal Reserve began keeping records in 1978. China's holdings have fallen below $750 billion for the first time since 2009. Saudi Arabia now settles a growing share of its oil exports to China in renminbi. Russia and India trade oil in rupees. Brazil and Argentina have begun invoicing grain in yuan. The dollar's share of global trade invoicing has collapsed from 88% in 2015 to barely 42% in the third quarter of 2025. The machinery that sustained American financial hegemony for 3 generations is coming apart at the seams. Most citizens of the United States still believe their currency is invincible, that the world will always need dollars the way it once needed British pounds or Spanish pieces of 8. They have been taught that reserve currency status is a permanent birthright rather than a historical anomaly with an average lifespan of less than a century. Yet every dominant currency in recorded history, the Byzantine solidus, the Venetian ducat, the Dutch guilder, the pound sterling, followed the same 7-stage trajectory from ascendancy to displacement. Each stage is driven by the same incentives, the same hubris, the same fatal miscalculation. And each ended the same way. The pattern is mercilessly consistent. Stage 1 begins with military and economic supremacy after a great war. Stage 2 sees the internationalization of trade and reserves. Stage 3 unleashes unconstrained financialization. Stage 4 delivers peak exorbitant privilege. Stage 5 weaponizes the currency against rivals. Stage 6 triggers fragmentation and flight. Stage 7 is sudden chaotic displacement. The United States completed Stage 5 in 2022 when it froze $300 billion of Russian central bank reserves overnight. We are now deep inside Stage 6. The consequences will not be theoretical. When the dollar loses its monopoly, the United States will no longer be able to borrow trillions each year without immediate pain. Interest rates will rise to levels that make the 1981 Volcker shock look gentle. The federal debt, already $36 trillion, will become mathematically unfinanceable without either default or deliberate currency debasement. Living standards that have been subsidized by the rest of the planet for 50 years will face abrupt contraction. The geopolitical reach that depends on those living standards will contract with them. History records no gentle transitions at Stage 7. Portugal's escudo collapsed in the 1530s after the spice route shifted. Spain's Real de Ocho lost primacy in the 1640s amid bankruptcy and deflation. The Dutch guilder faded in the 1780s after Britain seized naval supremacy. The pound sterling took 40 years to die after the Suez humiliation of 1956, but the descent was inexorable once fragmentation began. The dollar has already lasted longer than any of them. That is not proof of exceptionalism. It is proof that the final fall, when it arrives, will be from a greater height. The 7 stages are not a theory. They are an autopsy reports written across 5 centuries of monetary graves. The question is no longer whether the dollar will follow the pattern. The only question is how violent the final stage will be, and how many decades of our relative peace and prosperity will be sacrificed when it arrives. The 7-stage cycle begins in the ashes of total war. In 1453, Constantinople fell to the Byzantine solidus, had already been the world's reserve currency for 8 centuries, yet its final debasement came only after military defeat made redemption impossible. 3 centuries later, Portugal's victory over the Castilians at Aljubarrota in 1385 and Vasco da Gama's arrival in India in 1498 gave Lisbon the spice monopoly, and made the Portuguese real the first truly global coin. But its stage one ended the moment the Dutch and English began sailing around the Cape. Spain inherited the throne in the 16th century when Charles V's armies sacked Rome and the conquest of Mexico and Peru delivered 180 tons of silver and 180 kilograms of gold to Seville between 1500 and 1660. The Casa de Contratación in Seville became the Federal Reserve of its day, yet within 100 years Spain was bankrupt 7 times. The Dutch Republic seized primacy in the 1640s after the Treaty of Westphalia and the invention of the Amsterdam Exchange Bank in 1609. The guilder was backed by the world's first permanent public debt, the first central bank money market, and a navy that controlled the Baltic grain trade. By 1700, Dutch merchant houses financed half of Europe's commerce, and Amsterdam's bills of exchange were accepted from Archangel Theo of Batavia. Stage 4 looked eternal until the Fourth Anglo-Dutch War of 1780-1784 destroyed the Dutch fleet, and Britain's Industrial Revolution redirected capital to London. Britain's turn came in 1815. Waterloo left London, the only major capital untouched by 23 years of Revolutionary and Napoleonic War. The Bank of England suspended gold convertibility in 1797 but resumed it in 1821 at the pre-war parity, an act of monetary discipline no other nation could match. By 1870, sterling accounted for 70% of global trade settlement and 60% of official reserves. The Suez Canal opened in 1869 under British guns, the gold standard spread across Europe and America, and the telegraph cables T had left London's Pender Street carried pound-denominated prices to every corner of the earth. The City of London invented the euro currency market in the 1950s the same way Wall Street would later invent the euro-dollar market, by lending sterling outside Britain to evade domestic regulation. Yet the same pattern repeated. Britain's Stage 5 began in 1914 when the Admiralty embargoed German trade and seized enemy assets. The pound never recovered from 2 world wars fought on borrowed dollars. In 1931, Britain abandoned the gold standard. In 1947, the sterling area convertibility crisis forced rationing harsher than wartime. And in 1956, the Suez debacle revealed that Washington could crush London by threatening to withhold IMF support. By 1976, the pound had fallen so far that Prime Minister Callahan required a humiliating IMF bailout. Stage 7 arrived quietly in the 1980s when the dollar overtook sterling as the currency of oil pricing and global debt issuance. The United States began its own cycle on 22 July 1944 at Bretton Woods. America held 22,000 tons of gold, 2/3 of the world's monetary stock, while Europe and Asia lay in ruins. Harry Dexter White and his Treasury team outmaneuvered Keynes, imposing the dollar as the sole currency convertible to gold. The International Monetary Fund and World Bank were created in Washington, their voting shares weighted by dollar contributions. When France and Britain tried to redeem dollars for gold in the 1960s, the London gold pool collapsed in 1968, and Nixon closed the gold window on 15 August 1971. Most analysts believe the system had ended. In reality, the dollar was simply moving from Stage 2 to Stage 3. The 1973-1974 oil shock could have been fatal. Instead, Henry Kissinger and Treasury Secretary William Simon flew to Riyadh, and Riyadh agreed that all OPEC oil would be priced exclusively in dollars in exchange for military protection and Treasury bond purchases. The Petrodollar was born. Recycling hundreds of billions of oil earnings back into U.S. assets allowed America to run permanent current account deficits without currency collapse. Between 1979 and 1985, Paul Volcker's interest rate shock crushed domestic inflation and attracted a flood of foreign capital, cementing dollar hegemony just as Britain's had been cemented by returning to gold in 1821. By the fall of the Berlin Wall in 1989, the dollar accounted for 71% of global reserves and 85% of forex transactions. The 1990s and 2000s saw the final triumph of financialization. Glass-Steagall repeal in 1999, the commodity boom priced in dollars, the carry trade funded in dollars, the housing bubble financed by dollar mortgages sold to the world, America consumed, the world saved in dollars, and the Federal Reserve printed with abandon. Stage 4 had reached its zenith. The weaponization of the dollar began quietly on 8th November 1979, the day President Carter signed Executive Order 170, freezing $12 billion of Iranian assets in American banks. Overnight, any foreign government holding dollar reserves discovered that those balances could be rendered inaccessible by presidential decree. Tehran's response was immediate. It began stockpiling gold and seeking non-dollar trade partners. The precedent, however, was set. A reserve currency had become a foreign policy lever. Over the next 4 decades, the practice metastasized. In 1990, Iraq's dollar accounts were frozen after the invasion of Kuwait. In 1998, Venezuela's central bank gold in New York was quietly encumbered. By 2012, the SWIFT system, ostensibly a Belgian cooperative, expelled every Iranian bank at Washington's request, cutting the country off from 90% of global trade finance. Each escalation taught the rest of the world the same lesson. Dollar reserves were only as safe as America's current geopolitical mood. The decisive rupture came on the weekend of 26 to 27 February 2022. In a coordinated action announced from Washington, Brussels, and London, approximately $300 billion of Russia's foreign exchange reserves, mostly held in Western custodial accounts, were frozen within 48 hours. For the first time since 1944, a permanent member of the UN Security Council saw its central bank assets seized in peacetime. The amount was larger than the entire GDP of Portugal. The message was unmistakable. Even the second largest nuclear power on Earth could not rely on dollar safety. The reaction was swift and structural. Within weeks, China's central bank accelerated gold purchases that had already been running at 200 tons per year. Russia declared it would only accept rubles, gold, or yuan for energy exports. India launched the rupee-ruble trade mechanism it had designed in 2019, but never used. Saudi Arabia confirmed private discussions with Beijing about pricing some oil sales in renminbi. Central banks from Turkey to Thailand began dumping Treasury bond DS and buying physical bullion at the fastest pace since Nixon closed the gold window. By the end of 2022, the BRICS nations, now expanded to include Iran, Egypt, Ethiopia, and the United Arab Emirates, controlled 42% of global oil production and 38% of world GDP measured at purchasing power parity. Their combined foreign exchange reserves exceeded $4 trillion, yet only a minority portions remained in dollars. At the Johannesburg Summit in August 2023, they announced the development of a common trade settlement platform. At the Kazan Summit in October 2024, they unveiled the Unit, a blockchain-based token backed 40% by gold and 60% by BRICS currencies, designed to bypass both SWIFT and the e-dollar entirely. Meanwhile, the dollar's share of global trade finance continued its freefall. The SWIFT RMB tracker showed yuan usage in international payments rising from 1.9% in January 2022 to 4.7% by mid-2025, overtaking the euro for the first time. Russia-China trade conducted in dollars fell from 80% in 2021 to under 10% in 2025. India settled 22% of its Russian oil imports in rupees and UAE dirhams. Even France's Total Energies purchased LNG from the Emirates in yuan in 2023. The fragmentation was no longer theoretical. It was happening in real time on tanker routes and pipeline contracts. The United States responded with escalation rather than conciliation. Secondary Sanction S were extended to Chinese banks, facilitating Russian trade. The Treasury's OFAC blacklist grew to more than 15,000 entries. Yet each new restriction accelerated the exodus. When Washington threatened to seize Russia's remaining $5 billion in U.S. custody in 2024, Moscow simply defaulted on those bonds and moved the rest of its reserves to Shanghai and Dubai vaults. The weapon had been turned into a boomerang. By the third quarter of 2025, the dollar's share of global foreign exchange reserves had fallen below 57%, the lowest since the IMF began publishing data in 1995. The U.S. share of global debt issuance had dropped to 38%. Central bank gold purchases reached 200 tons in the first half of the year alone. The 7-stage cycle had entered its penultimate phase, and the speed of fragmentation was exceeding even the most pessimistic forecasts of 2022. The mechanism that turned Stage 6 into Stage 7 is brutally simple. Once a critical mass of nations perceives that holding the dominant currency carries more risk than benefit, the network effects that sustained its monopoly begin to run in reverse. In every historical case, the process followed the same sequence. First, commodity contracts diversify, then central banks shift reserves. Finally, private corporations and investors stampede for the exits, triggering a liquidity crisis for the former hegemon that no amount of money printing can fix without hyperinflation. For Spain, in the 1620s, it was Dutch and English merchants refusing to accept debased vellon copper coins for Baltic grain. For Britain after Suez, it was Middle Eastern oil producers quietly accumulating dollars instead of sterling balances. For the dollar today, it is Saudi Arabia, Brazil, and India accepting payment in yuan, rupees, or dirhams for the lifeblood of the global economy, oil, grains, and metals. Once the commodity anchor slips, the reserve currency's safe haven premium evaporates overnight. The numbers in 2025 are now unambiguous. The IMF's COFR data for Q3 showed the dollar's share of allocated global reserves at 56.8%, down from 71% in 2000 and continuing to fall at roughly 1 percentage point every 9 months. Unallocated reserves, widely understood to be mostly Chinese holdings, have risen to 18% of the total, the highest ever recorded. Central bank gold reserves have increased by more than 6,000 tons since 2010, with 80% of those purchases coming from non-Western institutions. The Bank for International Settlements reports that turnover in non-dollar forex pairs has doubled since 2019. At the same time, the cost of insuring U.S. debt against default through credit default swaps has risen above German bunds for the first time since the Eurozone crisis. The Treasury now pays higher yields on 10-year notes than Mexico or Indonesia in real terms. Foreign purchasers, who once absorbed 60% of new issuance, took less than 12% of the $2.4 trillion auctioned in the first half of 2025. The Federal Reserve has quietly become the buyer of last resort again, purchasing 68% of net new debt through its balance sheet expansion. The parallel to Britain's final decade is almost exact. Between 1956 and 1967, sterling's share of global reserves fell from 60% to 28%. The Bank of England repeatedly intervened to prop up the pound, draining gold reserves from $2.8 billion to $1.1 billion before the inevitable 14.3% devaluation in November 1967. The United States today has already spent down its strategic ADV advantages. Its gold reserves are officially unchanged at 8,133 tons since 1973, but revaluation to market prices would still leave it far behind combined BRICS holdings. Its fiscal deficit is running at 7.8% of GDP in peacetime, a level Britain only reached during the height of World War. Private capital flows tell the same story. Global dollar bond funds recorded net outflows of $312 billion in the 12 months ending September 2025, the largest sustained withdrawal since records began in 1995. Emerging market corporations have issued more debt in local currencies than in dollars for 7 consecutive quarters. Even Apple and Microsoft have begun raising renminbi and euro debt in Asia and Europe to match their revenue streams. The corporate treasury world is voting with its balance sheet. The tipping point approaches when the marginal buyer of treasury debt disappears. Japan, once the largest foreign holder, has sold a net $280 billion since 22 to defend the yen. China's holdings are now below $730 billion and falling. The remaining buyers are price-sensitive hedge funds and European pension funds that will flee at the first sign of forced deleveraging. When that moment arrives, interest rates will not rise by basis points. They will spike by percentage points in days, exactly as British gilt yields did in the 1967 and 1976 crises. History shows that Stage 7 is never anything in advance. It arrives on an ordinary Tuesday when a medium-sized country misses a dollar bond payment and triggers a cascade of forced sales. The last reserve currency to reach this point was the pound sterling, and the final act played out in 6 frantic months between the 1967 devaluation and the closure of the London gold pool in March 1968. The dollar has already been in stage 6 longer than sterling was. The mechanism is engaged and the escape velocity has been reached. The institutions that once guarded dollar hegemony have become its unwitting accelerators. The Federal Reserve, created to preserve confidence in the currency, now owns $8.9 trillion of Treasury and mortgage debt, more than China, Japan, and the United Kingdom combined, and has signaled it will purchase whatever is necessary to cap long-term yields. Each new intervention convinces foreign holders that eventual inflation or outright monetization is inevitable, prompting further sales. The U.S. Treasury itself has quietly transformed from the world's safe haven issuer into the largest high-yield borrower on Earth. In 2005, it issued $2.8 trillion in new debt while receiving only $340 billion in net foreign purchases. The remaining $2.46 trillion was absorbed by domestic banks, money market funds, and the Fed, a closed loop that functions only as long as private savers are willing to accept negative real yields. That willingness is evaporating. Household holdings of Treasury securities have fallen for 7 consecutive quarters. The SWIFT system, long described as neutral Belgian infrastructure, is now explicitly acknowledged as an extension of American power. Its board includes representatives from the New York Fed, and every major expulsion decision since 2012 has followed Treasury guidance. Yet this overt politicization has produced the largest unintended consequence in monetary history: the creation of credible alternatives. China's CFs processed $19 trillion in cross-border payments in 2025, more than triple its 2021 volume. Russia's SPFS and India's SFMS are now interoperable with CEAPS. Iran and Venezuela route 90% of their trade outside SWIFT entirely. The Bank for International Settlements in Basel, once the quiet coordinator of central bank cooperation, now publishes quarterly warnings about fragmentation risk while recording the fastest diversification of reserve assets since the 1930s. Its 2025 triennial survey showed non-dollar forex turnover rising from 12% of the global total in 2001 to 58% in 2025. The old monetary order is not being dismantled by revolutionaries. It is being abandoned by the world's most conservative institutions. The acceleration is now measurable in weeks, not years. In October 2025, the Saudi Central Bank announced it would accept IU and deposits from Chinese commercial banks, ending 51 years of exclusive dollar recycling. In November, India and Russia settled their first oil cargo entirely in digital rupees via blockchain. In December, Malaysia, Prime Minister Anwar Ibrahim openly called for an Asian monetary fund and a gold-backed regional trade unit. Each announcement lands like a domino on an already tilting table. The most telling indicator comes from the gold market itself. Since 2022, deliveries on the Shanghai Gold Exchange have exceeded those on COMEX every single month. Physical tonnage withdrawn from London vaults for Asian destinations reached 2,840 tons in the first 3 quarters of 2025, more than the entire official U.S. gold reserve. Central banks are no longer accumulating paper claims on gold. They are taking possession of the metal and moving it east of Suez. The power structure that remains fully committed to the status quo is Congress, which continues to raise the debt ceiling in trillion-dollar increments while refusing entitlement reform or tax increases. The resulting fiscal trajectory, 120% debt to GDP in 2025, projected 190% by 2035, guarantees that any attempt to defend the dollar with Volcker-style rate hikes would instantly bankrupt the federal government. The trap is perfect. The only politically viable path is continued money printing, and continued money printing guarantees continued flight. The truth that almost no one in Washington is willing to speak aloud is this: Stage 7 is no longer approaching. It began on 26 February 2022, the moment the world watched $300 billion of sovereign reserves disappear with the stroke of a pen. That weekend did not merely punish Russia, it terminated the centuries-old assumption that reserve currency status confers permanent safety. When the issuer can confiscate the savings of any nation at will, the currency ceases to be a store of value and becomes a geopolitical hostage. Every subsequent event has been an aftershock of that earthquake. The record gold rush by central banks, the collapse of the e-dollar's share in global payments, the birth of the BRICS unit, the quiet Saudi pivot to yuan pricing, these are not warning signs of a coming displacement. They are the displacement itself, unfolding in slow motion before our eyes. The dollar has not yet lost its plurality in reserves or trade, but it has already lost its monopoly on trust. Once trust is gone, the rest is arithmetic. History is merciless on this point. The pound sterling remained the most widely held reserve currency for a full decade after Suez, yet Britain never again enjoyed the borrowing power it possessed in 1955. Spain continued minting pieces of 8 until 1730, long after Dutch and English merchants refused them at par. The final phase is always characterized by denial at the center and frantic adaptation at the periphery. Washington today repeats the same assurances London offered in the 1960s, that the deficits are temporary, that the institutions are resilient, that no credible alternative exists. The periphery no longer believes it. The end will not look like hyperinflationary collapse on the Weimar model. It will look like Britain, 1967 to 1976, a long, grinding decline in living standards, masked by financial repression, capital controls, disguised as consumer protection, and a currency that falls in slow, sickening increments until one day it simply ceases to matter in global commerce. The United States will remain a great power, but it will finance itself the way every other great power has since 1815, through taxes, genuine savings, and the occasional humiliation of the bond market. There is a profound irony in the final act. The same nation that designed the post-war monetary order at Bretton Woods in 1944 has now, through the aggressive weaponization of that order, guaranteed its own supersession. The delegates who gathered in New Hampshire sought to prevent another 1930s currency war. 81 years later, their successors have ignited the very war they feared, not with tariffs or competitive devaluations, but with sanctions and asset freezes that no sovereign can ignore. The seven-stage cycle is not a theory. It is the distilled experience of every monetary empire since the fall of Rome. The Byzantine solidas endured 7 centuries because its emperors never weaponized it. Every currency that reached stage 5 perished within a single generation. The dollar has followed the script with eerie precision, and the curtain is already falling. What remains is not prediction, but acceptance. The era of American financial exceptionalism that began in a New Hampshire ballroom in 1944 is ending in the vaults of Shanghai and the oil fields of Riyadh. The world is not waiting for permission. It is moving on. One bilateral contract, one gold bar, one non-dollar payment at a time. The age of the dollar is over. The only question left is how much pain will accompany the recognition.